the factors one should consider before investing.
So what are those factors? One should always maintain 3 to 6 months salary or liquidity in their bank account before investing. Whatever you earn, at least 30% towards investment. Diversify your investment so as to reduce the risk. You should always invest for your goals. Appropriately insured. So one should have a appropriate life cover. See, whenever you invest, involve your spouse.
One should invest for long time.
To come into equity market, come with a horizon of minimum 3 to 5 years. If it is 5 years plus, we can also do justice for a portfolio. And generally there is a saying, longer the tenure of your investments, your risk is reduced, higher is the compounding effect.
So basically before investing, plan your investments.
Whatever you invest, you should invest for your goals.
That one should involve the spouse in their investment options.
She should be aware where I have invested and who is my financial advisor. Why this is important is, this guy, this husband has invested in different investment options, which the wife is not at all aware. Where and all he has invested. So to chart it out itself will take years.
Hello Wealth Seeker, welcome to Wealth Talks, your one-time financial solutions for all your wealth needs, where we discuss past, present and future of wealth management. I'm your host Yatish. In previous episode, we discussed what is wealth management and various topics on investments. In today's episode, we'll be discussing the factors one should consider before investing. Well, to answer all this, we had a special guest with us, Mr. Yogesh Mamani, who is a certified financial planner and CFA level 1. With over 20 years of experience in wealth management industries. Let's welcome him. Hello sir, welcome to the show.
Hi Yatish, how are you?
I'm good sir, how are you doing?
I'm fine. Thank you so much.
Yes. In previous episode, we discussed the basics of investing.
Right.
So in today's episode, we'll be discussing the factors one should consider before investing. So over to you sir.
See, basically before investing, one should look at the factors before actually they start investing. So what are those factors? There are certain factors like 13 to 14 factors which you should consider. Okay. Now, first factor, if you ask me, one should always maintain 3 to 6 months salary as a liquidity in their bank account before investing.
Okay.
And second point is, whatever you earn, at least 30% should go towards investment. Third point could be, as and when your salary increases, you should also increase your investments.
Okay.
Fourth point can be diversify your investment so as to reduce the risk.
Yes.
There is a famous saying, as we say, like, don't lay eggs in one basket.
Don't put all your eggs in one basket.
So generally we say diversify your investment just to minimize the risk.
Yes.
The fifth point, I can say you should always invest for your goals. As I earlier said, goals can be short term, medium term, long term. So that is the fifth.
Okay.
Sixth point can be basically whenever you invest, you should invest in an instrument that should beat inflation post-tax. So that is very important.
Okay.
Then seventh point could be basically invest for long term, because longer the tenure of your investment, power of compounding is high. Okay, so that is what we invest. We always insist clients to come with a long term horizon. At least look for 5+ years of investments.
Got it.
Okay. Then point can be basically you should ensure that you are appropriately insured. Okay. So one should have a appropriate life cover. Then point can be make sure that you and your family also has a family health cover. Health cover nowadays is also playing a big role.
Yeah, it's very important.
Post-COVID, you might have seen the medical expenses were so high. A lot of people were unable to even bear those expenses. But people who had medical coverages, medical expenses, like medical policies and all. So they were able to bear the expenses. So
now I think people are more aware of that medical expense.
correct. So that is again one of the important factor when it plays. Then another factor could be always invest in joint names. Okay, like for a husband, he can make wife as his joint holder. So it's always good.
Okay.
Then another point could be, see, whenever you invest, always involve your spouse in the investment, so that she is aware where and all you are invested, through whom you are investing, basically who is your financial advisor.
Yes.
So make sure that he or she is also aware about your investments.
Noted.
Then finally what we say is, basically you should have a will in place, so that nobody can challenge the will. And the important point in that is, in will basically you put down all your investments, right, from your financial instruments to your real estates, gold, everything you put down on the will. And finally you hand over the will to the financial advisor, to the lawyer, so that in case there is any unforeseen events or in case of any emergencies, the lawyer is there, the financial advisor is there. Okay, so nowadays estate planning is also playing a bigger role. So
real estate
planning, not real estate. Estate planning. So which is all of this, will, trust, forming a trust and all. So that is also playing a bigger role when it comes to wealth management. So these are certain factors you should consider even before you invest.
Okay. Sir, you informed that we should maintain 6 months of salary as emergencies. So please justify the answer.
See, basically, whenever you invest, we always say you should maintain 6 months, 3 to 6 months salary in your bank account, so that it supports in terms of emergency or unforeseen events. See, because when you invest, what happens is, we will invest based on the horizon. Okay. Now suppose you have a lakh of rupees, entire lakh of rupees you give to advisor. So based on the horizon, he will invest entire 1 lakh of rupees into some investment options. So in terms of emergency, now your money is entirely invested. So in terms of emergency, where you will run? So you have to come and break those investments. And that moment, suppose those investments are not doing good. Likewise, suppose you invest in mutual funds and markets are down. So in terms of emergency, you come to me, ask me, can I pull the money? And if that moment market is down, so you will get into the losses. And it may take 2 to 3 working days to break the investment and credit back to your bank account. So we always insist, even before getting into any investment, you maintain at least 3 to 6 months salary into your bank account. So you need not have to run for any emergencies.
Yes, sir. Previously, you have mentioned that after every salary hike, we should increase the investment options. So can you please elaborate on that?
Yeah. See, generally what I say, what I advise clients is, first thing is, whatever you earn, 30% should go towards investments. Say, okay, because there is a general saying, how much you earn and how much money you have in your hand, generally people will spend that.
Yes.
So we generally advise people at least 30% should go towards investments.
Minimum 30%.
Minimum 30%. If you are able to shell out more, I think you can build a healthy portfolio within a short while of time. Okay. Now going ahead of that also, we always insist people, see, suppose today you are started with 1,000 rupees SIP and your salary is 10,000 rupees.
Yes.
Okay. Next year you get a hike of 20%. That means your salary of 10,000 has increased by 2,000 rupees. Your next year your salary has been increased by 2,000 rupees. So what we say is, as your salary increases, so should your investment also increase. Now, this year you started with 1,000 rupees. And your salary increment has been grown by 20%. So minimum, whatever is the salary high, 60% of that should go towards investments.
So we should increase investment by 1,000 every month.
Why I say, why I insist client? Because as your salary increases, by default your expenses will increase.
Yeah.
Why not your investments?
Yes, we should do that.
So if you are able to save 50% of your salary increment, I think within a short span of time, you can build a healthy portfolio, and you yourself will wonder. It will be a great portfolio within a short period of time.
Yes,
So
sir, that
generally we
was very
advise
insightful. Sir, you also said that one should invest for a long time. So what do you mean by that?
There are two different things. Generally, we say to come into equity market, okay, you should come with a horizon of minimum 3 to 5 years. Okay, if it is 5 years plus, we can also do justice for your portfolio. And generally, there is a saying, longer the tenure of your investments, your risk is reduced, and higher is the compounding effect. So today, if I say you invested 10,000 rupees per month, and if you get average return from mutual fund is 12 to 13%. So 12% on 10,000 is 1,200 rupees.
Yes.
In first year, you may not see that much growth. So 1,200 is like a peanut for you.
Yes.
But second year, what will happen is 10,000 plus this 1,200 will be added.
Will be added and will be getting interest for
Next
added
year,
one.
next year, it will be like on interest, you will be earning interest.
Yes.
Principal plus interest, on that you will be getting another 12% kind of return.
Okay. So it will be compounding every year.
So compounding effect will be more when it comes to long term. In shorter tenure, you will not be able to see that much returns. But of course, for long tenure, the effect is very high. And also, second thing is, if you come for short term, market volatility is there.
Yes.
Okay. So generally, we say any client who come with a longer time horizon, so that your risk is also minimized.
Okay, so long term means, so how long it is?
We generally insist when you come into equity markets or equity related instrument, 5+ years tenure is what.
So 5 years should be minimum.
Yeah.
Okay. More than 5 years, that's
always good.
That's always good.
That's always good.
Okay, sir. Sir, you have mentioned on diversification. So how important it is?
See, you might be already aware, and I always keep saying that never lay eggs in one basket. Yes. Okay. What do you mean by that is diversify your investments. So never invest in one typical instrument. Okay. And as I earlier also said, in investment we follow thumb rule: 100 minus your age is what you should take the risk.
Yes.
Okay. So suppose you are 30, 100 minus 30 is 70. So 70% of your fund you can invest taking risk. In that riskier instruments also there are different instruments. For example, mutual funds. For example, direct equities.
Yes.
For example, you can get into PMS. So all those instruments are there. And another 30% should be safe. So those are like debt funds. Okay. EFDs. Okay. So those all instruments are there. So what happens is, for example, 3 months back, when equity market has crashed. Now suppose you had invested entire your corpus into equity market. Okay. If that moment if equity falls, okay, entire your money goes for a toss, means it will get into losses.
Yes, our portfolio will be seeing red.
But at the same moment, if you would have invested in bonds, okay, there was a rate cut during that period. Okay, now bond prices will go up if there is a rate cut. So if you would have balanced your investment, some portion in equity, some portion in bond, although equity might have come down, but because of rate cut, your bond prices would have gone up. So that would have been balanced the portfolio. So generally diversification will reduce the risk and your portfolio is balanced. So you are also into a safer investment and you are also well protected. And it is a win-win for both of us. We will never advise you to get 100% into equity or get 100% into balance for debt funds or gold. So we will always diversify your investment because we need to protect and also to grow. So first important point for us for diversification is to reduce your risk. Also, if you can protect your portfolio. So by diversification, we are trying to minimize the risk and also protect your portfolio.
Yes. So which is the more riskier option in this?
Basically, everybody knows it is equity, but of course with experts' advice,
Hmm.
we can minimize the risk.
Sir, you also mentioned that our investment should beat our inflation. So, what do you mean by that?
Yeah, that's a very good question, Yatish. See, generally what happens is we invest in fixed instrument. For example, a lot of people are investing in FD. Now, currently, assuming FD rates are 7%. Assuming.
On an
Just an assumption. 7%. And inflation, assuming it is 5%.
will be around 5 to 6%.
Let's take 5%.
Yeah.
Just an assumption.
Yeah.
Just to brief you.
Okay.
Now on a FD, suppose I fall in 30% tax bracket.
Okay.
If FD is giving 7% return, I have to pay 30% tax on that. So on 7%, 30% is 2.1%.
Yeah.
So 7 minus 2.1. So post tax, I will get only 4.9% return.
Yeah.
Okay. Now what is the inflation? It's 5%.
5%.
So your FD returns are not even beating the inflation. What do you mean by that? See,
We are in a law.
yes, my wealth is not growing. It is eroding. So I generally insist, a lot of financial advisors also insist, anything that you invest, first should beat inflation. Second, post-tax, it is very good. So generally we insist people, wherever you invest, just ensure that your returns should beat inflation post-tax. Only up those investments.
Yes.
So that your wealth will not erode, but it will grow.
Yes, sir, got it. That was one of the nice factors to consider. Because most of the people nowadays, they're investing more in FDs. So I think 90% is in FD. That was one of the good factors to consider.
Yes.
Yes, sir. You have mentioned something on goal-based investing. So can you please elaborate on that?
This investment that you are doing will suffice your goal.
Yes. So basically, before investing, plan your investments.
Now this 20 lakhs, 16 years down the line, when your kid